This is a list of stocks in the same industry with the price to free cash flow ratio. Notice anything in particular? This stock price to free cash flow ratio absolutely sucks. Understanding this ratio is critical to avoid overpaying for stocks and finding good investment opportunities. But how do you calculate this ratio and how do you use it? Stay tuned as we uncover this step by step. Before I show you how to calculate this ratio, you need to know why these ratios are important in the business. And there's no one better at doing this than Warren Buffett himself.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
As you heard, paying the right price for a particular company is key to making good investment decisions. The price to free cash flow ratio is a great way to know whether we're paying too high of a price or a good price for a particular company. Think about it like this. If I give you 10 chocolate bars for $20, you're paying $2 per chocolate bar. This is a much better deal than if I give you 10 chocolate bars for $300 because you're essentially paying $30 per chocolate bar. The price to free cash flow calculation works in the exact same way, except instead of chocolate bars, it measures cash flow. This is the sweet cash that helps increase the value of your stock by doing share buybacks or sharing that cash in the form of dividends to shareholders. The calculation is simple. You take the price of the stock divided by the free cash flow per share of a company, or you can also use this other formula. The higher the price to free cash flow ratio, the more you're paying for a particular stock. Whereas the lower the number, the better of a price you're getting. Let's calculate this number for Apple. You can get the financials using Y-sheets like this. Then head over to the key metrics tab and divide the market cap by the free cash flow in the cash flow statement. The key question now becomes, is this a good number or a bad one? To find out, you need to compare the number with a list of similar companies typically in the same industry or sector. For that, you can get a list of companies like this using the Y-sheet screener. Then get the price to free cash flow ratio on a TTM basis. As you can see, the numbers are very similar, except for AMD, which has a terrible price to free cash flow ratio compared to the other ones. So what do? Avoid companies like this, like if a bull was chasing you. Now there's one more thing you need to know that differentiates great investors from mediocre ones. And that is the ability to know when paying a higher price to free cash flow ratio is worth it. Now, I know what you're thinking.
I thought you said don't pay a high free cash flow ratio.
Yes, that's true for the most part, but there are a few companies like Amazon was back in the day where they're focused on taking all of the company's free cash flow and reinvesting it in growing sales and becoming more and more difficult to compete with. In those cases, paying a higher price to free cash flow actually makes sense because at some point, the higher revenues and better competitive position will lead to more free cash flow, and the high price that you pay can become irrelevant. There you go. Now you know how to avoid overpaying for stocks. If you've enjoyed this video, make sure to not let Warren Buffett down and subscribe to the channel, and I'll see you in the next one.